If you don't know what you're doing, it's a jungle out there.
If you were going to invest, let's say you had $100,000, $1 million, and you wanted to invest it in the stock market, Peter, what would you be looking for in the accounts? What would the accounts show you that would differentiate between this is a good company to invest in and this is not such a good one?
Well, Colin, first thing, the accounts, published accounts, are what I call bikinis.
What? Bikinis?
Bikinis.
Oh, okay.
They show you a lot, but most important thing, they don't show you. Okay, right? Very important. Now, but if you want to look at investing, the numbers only show you the quantitative. You need to go beyond the numbers and actually understand the business. If you want to go into the business, if you want to become an engineer, Colin, what would you do?
You'd go and learn engineering.
Yeah, you go and study. You want to become a doctor, what do? You study. You want to become an accountant, they start for 5 years. You want to be an investor, so you take the money and just throw it down. Most people don't study. They don't even know what they are going into. You must get to know your business. Let's say if you want to go, whatever, you want to go into properties, you have to study. You want to go into electronic, you study. You must be comfortable with the numbers, the profit and loss account, the balance sheet, the cash flow will help you. But it is only a aid. You still need to understand the nature of the business you're going into. It's just like you want to go into engineering. You look at all the numbers, it's telling you, oh, you're making so much money. But still, you need to know whether you like that business, you understand what you're doing. Then you become a good engineer to make a lot of money in the same way. So if you look at the profit and loss account, balance sheet and cash flow, this is the three statements that we are looking at. What are they? First thing is, one shows you the performance of the company. Another one, which one, and if I were to talk to you on which one shows you the performance, it is a profit and loss account. Profit and account measures how well the company is performing. If you look at a company, you want to know how well it is performing, then if it's performed very well in the past, let's say you need to look at 5 or 10 years in the past and see how well it is performing. 5 years is sufficient, 10 years is better. If you can get 10 years data, look at how well it's performing. Does it mean that if it's performing well in the past, it's going to perform well in the future?
Oh, maybe not.
Maybe not. I mean, you've been a good boy in the past now, Colin. Does it mean you're going to be a good boy in the... Nah. It depends on what you're going to do now, So, but it's a good indication. If you've been good, it's a good indication that you're going to be good in the future. So it's just an indication. So when we look at numbers, very important. We are looking at where the indication of what is going to happen. The rest, we must understand the business itself. One, to make profit, you want to may not be super profit, but if you want to consistently, you want to look for business which is steadily giving you, that are performing steadily. In other words, so you look at the performance steadily.
Yeah, and so in that performance statement, the first thing that's important is, I mean, you've been saying all the time, I've been knowing you 20 years, you've been talking about cash is blood, without cash you're dead. So in the performance statement, the first thing that's got to be relevant in the whole game, the thing that's where's that revenue coming from? I appreciate it doesn't give you the amount of cash come in, but where's this revenue coming from on a regular basis?
Very good. The revenue is coming in. Who brings in the revenue?
The sales team.
The sales team.
Yeah.
Therefore, the sales team must be given first priority.
Yeah.
But you can't see that in the profit and loss account.
No. But you need to actually, I believe, you need to go behind the accounts and find out who's my customer.
Yeah. Who are
they going to remain my customer?
Yeah. Are they going to be durable customer? Are they going to consistently give you? No. If you look at a food business, look at hamburger. Everyone is buying hamburger, but which hamburger? Say McDonald's. What do you call? The King, the one is called Burger King or Whopper King or Hungry Jack, but but they are constant business. It's just that which one, or you look at drinks, Pepsi, Cola, or coffee, or no, it has. These are constant business, and if you look at it, the performance itself comes from the customer. The customer must want. The key in the business is this business keeping the customer happy? Look at Walmart in the what I call grocer business. there's always everyone buying grocery every day. It's what?
So
why do they decide to come into your supermarket and not because when they come in and they buy it, they feel good. At the end of the day, the goal of the business must be making the customer happy. So if you look at the business, is this business making the customer happy? You look at the income is coming in. Then what you want to do is go and test and see whether you go into the business, are they making you happy?
Sure.
So you need to go. So that is where but the income, the sale may or not be cash, because what happens? Some of them are paid in cash, some of them are paid later on. So the income is not cash. It's cash that is coming in. Some of them has already come in. Some of them are still coming in. Some of them call in.
Never come in.
Never come in. They are called bad debts.
Yeah,
no.
Sure.
Then you have expenses.
Right.
Money going out. Like you have expenses like electricity. You use it, you haven't paid yet. Stationery, employees.
So what are these accounts then? Looking at them from an investment point of view, you're actually
looking at profit.
The
are they making profit?
Accounts shows the thinking of the management, isn't it? Because it shows where their money's coming and what they're doing with their whole business in the performance.
It's like a chicken. You look at a chicken, what must a chicken do?
Lay egg.
Lay egg. If the chicken doesn't lay egg. So if you don't make profit, consistent profit, so you look over the last 5-10 years, is it making consistent profit? How many percent of that profit compared to sales? How many percent is it? 20%, 10%, 5%? Is it going up? Is coming down?
Yeah. So can you get the cost structure? You could work it out yourself if you didn't get it. Of the business that you're investing in, you could actually sit there and work it out yourself. If you didn't get, because you wouldn't get it on the. They wouldn't give you that, would they?
No. Then you can just
take it out. That's a management account.
And even if you look at a published account, it is very scanty.
As you say, it's a bikini.
It's a bikini. You can't see the real thing, but you see, for whatever you have, you can say, okay, fine. This is the income. This is the sales. Everything divided. The sales means money coming in. Then you take the cost of goods sold divided by the sales. Then you can see this is 60%. If it's 60%, means for every dollar that come in, 60 cents go to the
So that's one way of measuring one type of business. So if you were, say, let's just stick with your engineering thing. If you were going to invest in an engineering business, then you're looking at one business versus another business as to, well, shall I buy this one or this one? You could actually look at the cost structure of maybe 2 or 3 of them, and then you'd see which one's got the best cost structure, and you actually get down, wouldn't you?
In other words, it's okay for every dollar that come in, how much goes to the cost, how much goes to the operating, there's a percentage, and how much is left, net profit percent, net profit divided by sale, that is percentage, how much is left. So you can say, okay, fine, the industry average is 20%, and this company is only performing at 5%, or this company is performing at 30%, industry average is, wow. And then you need to, once you understand that, then you know, why is this company performing better than other people? And can it consistently keep up that performance? Or
do they have a problem, or the one that's not performing, has it got a one-time problem that you can get in there and solve possibly?
That's why you need to look at 5-10 years so that you can see the trend. So that shows you how well the company, or how efficient the chicken has been. If you want buying a business is quite not much different than buying a chicken. Look at the chicken. Oh, this chicken has been laying egg, and this or maybe this chicken is going old.
10 years old, he's becoming redundant.
It doesn't mean the past equal the future. The past may be doing.
But if you're going to really invest, I guess this is why Warren Buffett says, understand the business and understand accounting, because if you don't understand the business, don't understand accounting, then you don't know what you're doing.
Because
you got no idea.
Accounting is the language. How it is expressed, dollars and cents, that's what accounting is. So I would look at how well it is performing. If you're asking me how well, then I will look at, has it got ability to perform in the future? If you look at the chicken, Colin, it is laying good egg. What is keeping the chicken alive?
The blood.
Yeah, if it has no blood, it dies. What is the blood in the business?
Cash.
Cash. You see, you don't run your business with profit. You can't buy nothing with profit. You cannot do anything.
Yeah.
You run your whole life at home and you run your whole business with
No cash, no food.
no cash. You tell the children, tonight we play a new game. Everyone sleep early tonight. We are not going to have dinner. And if you have no cash, you tell the children, this year we are not going to Hawaii for holiday. We are
Well,
going to.
that's why I was saying before, you have to go back to the revenue and say, where's this cash coming from? Because without it,
Because
it's the only reason
if
you're
you
in
have no
business.
profit, you'll never have cash. Why? Because there is a time lag. The profit has not become cash yet.
Yeah.
Better still in your business, in some business like Michael Dell and direct sales business, what you do is collect the business cash
the
first.
cash first.
In other words, the cash come in first before the product go out. In other words, your company is, look at all the multinational, the big companies who are very powerful because they have a lot of, look at the countries which are powerful.
It's almost like the same as the petrol. You go down to the garage here, and although you put your petrol in and then you go and pay, but you pay instantly because you can't drive away from the garage without paying.
Yeah. So cash is
And
so
it's the same on the internet. Internet marketing is all about researching before you have a product or getting on the internet. You've got to find out what people are looking for first of all. So in other words, you're looking for the desire,
The customer.
because from the desire comes the cash, and then you structure to satisfy that desire. If you find people are out there not satisfying the desire, there's the opening, and it's the same in the public companies, isn't
if
it?
you have no customer, Colin, you have no business.
Because it's not a matter of buying the same company. It's not a matter of buying the company that's doing the best. It's out of if there's an industry, and then we'll stay with the engineering. Let's just say engineering is the industry at the moment. Then there's got to be a company in there that's not doing well that you could actually go and buy and take, like Buffett. You can go and buy, fix it up, and it'll be as good as the other one because it's got a cash flow stream but a bad management team.
Yes, sometimes
or in the wrong location or whatever.
You got a good product, you got a good customer base,
And
but
bad
it's
management.
poorly managed.
Yeah.
So
Managing
just
people managing
look at
from
the
their
number.
ego as opposed to
If you-
managing the business.
Yeah, looking at the number, you think the company is not doing well, but you need to go be the number is a guide.
Yeah, exactly.
That's why when you ask me, what will you look for in numbers?
Yeah.
Give you an indication, but we need to go. But basically, if you look at business, it's only a flow of product and cash. The product movement is recorded in a profit and loss account. The cash movement is a cash flow. So when you are in a business, you need to make sure if you are going to buy a business, is it performing well? Has it got cash? You open up the cash. You open up the bank, the balance sheet. Look at the cash balance. Has it got any balance?
Over 10 years, you can see if it's going up or down.
Going up and down, right? And then you look at the equity. Is the equity growing? So when you start the company, let's say at 100,000, at the end of the business period, has it gone up or come down? If it's gone up, I mean there's growth. So you need to see how much is the growth. So why are you in business? To make money, so that you can become wealthy. Wealthy means what? Your equity goes up. By the time you retire, Colin, how much wealth you want to have? That is your balance sheet. Your total asset minus your total liability. What you own minus what you add. And that's what a balance sheet. So three things I want to look at: the profit and loss account, the cash flow, and then the balance sheet. The profit and loss account shows you, hey, how well am I performing? How well the chicken is laying eggs. Is it laying eggs efficiently? Secondly, has it got ability to perform? Has it enough blood? And then, what is the growth over the last period?
So
10
those
years.
are just the three things that you find. The rest of it is nonsense, isn't it? I mean, the rest of it's a smoke screen.
Yeah,
or
I
it
want
shows
to-
you how close or how much truth is involved in it.
Yeah, because all the statement shows, if you look at the auditor's report, what did the auditor's report say about the
Yeah, true and fair.
true and fair? The accounts are not accurate, but it's just true and fair. It's an estimate. It's an opinion expressed. If it's my account, it's an opinion expressed by my company. You need to take that and then go beyond the numbers and find out, Yeah, but this is an indication that this company is doing well. Now, you need to, if you want to put money in that company, you need to understand the business. Probably you will understand that more and always say, I don't go into business that I don't understand.
And you can appreciate that, isn't it? I mean,
Yeah.
Because if you can't, by understand, you've got to know where the income is and how reliable the income is.
Good.
And then what's the performance of the cash that you receive? What do you need to keep doing with it if you've got a lot of research and development, or you've got a lot of tooling up costs, or all of these sorts of things that are going to eat up that cash flow, and there's no profit at the end of it, or very little profit for the amount of money going in, then what's the point?
Yes. So the three statement, coming back to your question again, what do I look at? I look at is making profit, look at the income, where it's coming, where expenses, what kind of expenses are they paying out, you know, what kind of expenses. Then you look at the cash, is there enough cash to continue to perform, and then look at the growth. And these are three things I would look at. And these are only, let's say, indication.
Yeah, sure. And
You just can't run the company just on numbers. You need to go beyond and find out exactly what the company is.
And so now you've got to the point and you say, okay, I'm going to invest in that company. Then, just based on what you've said to me in the past about, is it a gamble or is it an investment? It's only an investment if these guys are they going to continue to pay out, or have they been paying back out to the shareholders, or have they been putting the money back into the business over the years? Because if they're not paying out to the shareholders, then you're not going to get regular income either out of it. So that's important, isn't it? So you either get regular income in the form of cash coming into you from your share investment. Otherwise, they're putting the cash back in to keep buying more and more and building up their business, but therefore your share price must be going up because that's classed as regular income as well, correct?
Or
would you rather see the cash?
Well, it all depends. Now, if you are a retired...
That sounds like a political...
Not at all. It all depends. If you are a retired person...
Yeah.
And you need the cash... You got a lump sum that you want to put in, and you need income now to live. You want the regular dividend.
Cash.
And you want to invest in companies that give you regular in cash, because that's what you're going to live on. But if you are having income from some other source that maintain your life, and you put into a company that plows back all its profit and does not distribute, which means it increases your capital, your equity, then your worth goes up very fast. I mean, if you look at Dell Computers, in the first 10 years, they grows by 86,000%. You got one share, $1, one share. Can you imagine that? It's because they don't distribute. So it's either you distribute, you see, when a chicken lay eggs.
Yeah, you can't have it both ways.
Yeah, then if the eggs are put back for hatching, the growth is wow. Yeah. And if you take that eggs out, crack it and eat it as omelette, as dividend, then Colin, no,
it's limited.
Yeah, so it's either, it depends on your need in investment. If your need is, hey, I need a regular income, then look for a company that gives you regular. But the growth is not going to be excellent. So this is like what some people say, gambling or investment. Is this a gamble or an investment? What is the difference between a gambling and investment? Both are risk. Both are managing risk. Right? The only difference is when you put the money in gambling, let's say you put in a lottery, put 100,000 lottery. While you're waiting for that, you put 100,000, you're going to get millions of dollars out. No? Now, while waiting for the result, is there going to be regular income? No.
There's a dream.
No. You put your money in soybean.
Yeah.
You put you buy gold. There's not going to be regular income, right? But if you put money in a share or business or real estate, where you get regular rental income or regular dividend or regular profit, what happens is, when you put the money in there, there is some cost for that money. Yeah, sure. Either you have to pay interest or your interest for God.
Christmas.
Yeah. Then if the income comes in, it can cover for your expenses. Then you can afford to wait.
Yeah, sure.
There's risk is So sometimes people, just one moment, sometimes people say, should I put in this money in gold? Or should I put it in soybean? Or should I put in, there's no regular income? The question I'm asking, can you afford to lose it? Is gambling good or bad? If you can afford to lose it and nothing happens to you, but don't put your whole saving in that. What I call gambling. You put it, because now gambling has got no regular income. And when you lose it, you lose. But then with gambling is, the return is very high.
It's a bit like negative gearing as a gamble, isn't it, really? Because it's negative gearing is expecting the price, the capital gains on the property to go up in the future, and in the meantime you're writing down tax and drawing down your own cash. It's actually gambling.
Where there is no regular income, it is pure. All gambling is you put it in the money, in the meantime you wait. Please let the price goes up. There's capital gain. And usually when there is no regular income, capital gain is very high. So, I mean, if you talk about property, when you buy property, there are properties which are regular income. But the gain, the capital growth may not be, but there are also property which got good regular income and very high
capital gains.
But normally, where the capital gain is very high, the income may not be that. So, which one do you buy? What I say is, be conservative, put where there is regular income, you got the extra cash, dump into who knows?